What's up? In this video, I'm going to go through the #1 tax loophole for real estate investors. And if you stick around, you might just learn how to save up to 5 to 6 figures in taxes with this little known tax technique. Hi, my name is Thomas Castelli, and I'm a CPA and tax strategist who helps real estate investors keep more of their hard-earned dollars in their pockets and out of the government with proactive tax strategy and planning. If you do like this video, make sure to hit the like button as well as the subscribe button and the bell icon so you don't miss out on future tax tips that might just save you 5 to 6 figures in taxes. All right, so what is the #1 tax loophole for real estate investors? And it is none other than the short-term rental loophole, or the STR loophole for short. So what is the STR loophole? What does it do? And how does it help you reduce taxes? And more importantly, how do you actually use it? What are the steps? So I'm going to break down what it is, and I'm going to go step by step through how to use it for your situation. All right, so let's go ahead and dive right into this. So the short-term rental loophole allows you to take the losses from your short-term rental properties and use them to offset your W-2 or active trade or business income, which can significantly reduce your taxes, sometimes up to 5 to 6 figures. So that's what it does. Now, what are the steps? The first step is you need to have a rental property that has an average period of customer use, or average guest stay is just another way to look at it, of 7 days or less. And if you have a short-term rental property that is in a good market for short-term rentals, perhaps a vacation market, or a market where people come and stay for short periods of time on a frequent basis, you could throw your property up onto Airbnb or VRBO. Of course, you want to optimize it for the market you're in, but you can throw it up on Airbnb or VRBO and rent it out for an average period of customer use of 7 days or less. So that's step number one. You need to have an average stay of 7 days or less. And the reason for this is it allows you to bypass the passive activity rules. If you had an average stay of above 7 days and you didn't provide substantial services or hotel-like services to your guests, then it would be considered a long-term rental property and you wouldn't be able to use the STR loophole. So it's key that your property has an average stay of 7 days or less. That is step one. Step number two, you need to materially participate in your short-term rental properties by meeting one of 7 material participation tests, but 3 are most relevant to short-term rental investors. And the first one is going to be that you spend more than 500 hours on your short-term rental, or you do substantially everything yourself, so you're kind of like a one-person band. Or number 3, which is by far the most popular test, you spend more than 100 hours on your short-term rental and no one else spends more time than you. And that's key. Now, the good news is with a short-term rental is that if you are married, the time you and your spouse spend on the property are combined as one person. So you're considered one person for these purposes. So if you're going for that 100-hour test, you and your spouse combined need to spend more than 100 hours and make sure that nobody else spends more time than you. And the reason why this is so popular is because you can still delegate cleaning and repairs to other people. You just need to make sure that you're spending more time than them. So that is the second step. You need to materially participate. And one last thing before I move on, material participation usually means that you are self-managing the property and you're not using a property manager. Again, you can delegate certain tasks to other people, but if you hire a property manager, the IRS is going to assume that you're not materially participating, and it can be problematic. All right, now we're going to move into step number 3, and that is you want to use a cost segregation study and bonus depreciation to increase your losses from the property. Now, you might be thinking to yourself, why do I want to create losses on a property? I don't want to lose money. I want to make money. Well, here's the thing. With depreciation, it is a non-cash expense that allows you to reduce your taxable income without actually reducing your cash flow. In other words, when you use depreciation, you might be creating a loss for tax purposes, telling the IRS that you lost money. Meanwhile, you might actually be putting money into your pocket. And what a cost segregation study does is it breaks down the various components in your property into different class lives. And if the property has a class life of 5, 7, or 15 years, well, then it can be rapidly accelerated with something called bonus depreciation. And bonus depreciation just basically allows you to front load a large portion of the depreciation in the first year you put the property in service and you start operations, rather than having spread it out through multiple years. So that is the third step. And then the fourth step is making sure that this gets onto your tax return, so you're actually capturing the benefits of this strategy. And that's usually done by a qualified tax professional who can actually go ahead and file this for you on your tax returns. So let's go ahead and recap what we learned here so far. So first things first, the short-term rental loophole allows you to take the losses from your short-term rental properties and use it to offset the income on your W-2 or active business income, significantly reducing your taxes. And the steps to get there is you need to have a property with an average stay of 7 days or less, and then you also need to materially participate in your property, which is commonly done by spending more than 100 hours on your property combined with your spouse. and no one else spends more time than you. And again, this allows you to delegate certain tasks to other people. And step number 3 is you want to run a cost segregation study and combine it with bonus depreciation to maximize your non-cash losses in the first year you buy your property. And that is what leads to substantial tax savings. And then last but not least, this does need to make it onto your tax return, which is typically done by a qualified tax professional. So do you have questions about the short-term rental loophole? If so, go ahead and drop them into the comments. I'm going to be answering as many questions as I can. And if you do like this video, make sure to hit the like button as well as the subscribe button and that bell icon so you don't miss out on future tax tips. And last but not least, if you are looking for a tax professional to help you navigate the short-term rental loophole and apply it to your situation, then go ahead and click the link in the description to this video for a free 30-minute discovery call where we'll find out whether or not we can help you use this and other real estate tax strategies to substantially reduce your tax bills. Looking forward to seeing you on the other side, and I'll catch you in the next video.